Welcome to the Daily Insights That Matter. We begin today's DITM by talking about the bank's decisions to raise the deposit rates. The banks in India have started raising deposit rates gradually as credit growth continues to outpace deposits at a time when the system's liquidity is drying up. ICICI Bank, HDFC Bank, Canara Bank and Yes Bank amongst others have recently raised deposit rates in the range of 25 to 75 basis points, and many more are likely to follow suit. The current hikes, including special festive season offers, have taken interest rates in some deposit brackets to 7% and above. The rate hike was applicable not just on retail deposits but on bulk deposits as well. The bulk deposits are those deposits which are above 2 crore rupees. Now, most lenders have been wary of increasing deposit rates as it affects their margin. That being said, while the RBI's repo rate and the interest on loans linked to it have increased by 190 basis points within this fiscal year, the weighted average rise in term deposit rates on outstanding deposits has increased by a mere 26 basis points only as of August. So we had spoken about the bank's liquidity slipping into a deficit in last Wednesday's DITM episode. While banks have been raising their lending rates, they've not shown similar enthusiasm to hike the deposit rates as well. However, the lack of abundant liquidity has now forced them to woo deposit customers. The higher demand for loans can only be met by rising deposits. Now, since the beginning of 2022, there has been a surge in oil prices owing to many reasons. Domestic energy producers were making windfall profits by selling crude oil to domestic refineries at high international prices. In July, the center had imposed a windfall tax on domestic crude oil producers in an effort to stop this, but later reduced the windfall tax due to easing oil prices. Now, even though crude prices are on a declining trend, the government yet again made a fresh decision to raise the windfall taxes. Let's understand why. Now, the tax on crude oil produced from domestic fields has been raised by 37.5% to rupees 11,000 per ton from 16th October. After earlier scrapping, exports of aviation fuel will now attract a levy of rupees 3.5 per litre. Tariff on diesel exports will increase to rupees 12 per litre from rupees 5 per litre earlier. We believe that the Organization of Petroleum Exporting Companies, or OPEC's, announcement of a reduction in crude supply on the global market with the intention of driving prices upwards prompted the decision to raise the tax on diesel and domestically produced petroleum and to reinstate it for the ATF exports. Now, the crude oil prices have been volatile in the recent months. Despite being on a downward trend, they are still very high. If the stability in oil prices continues, this will help in further reducing windfall taxes. So what does all of this news mean for you? The rise in deposit rates will help bring the liquidity back into the system, thus helping the overall credit growth. This will have an indirect and a direct positive impact on you. The tax on domestic crude oil output would mainly affect the margins of domestic oil producers, and levy on exports of fuels will mainly impact private refiners. If you're invested in this sector, then this will have an indirect negative impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.